Good morning and welcome to today's webcast, Senior Care Facilities, Reduce Risk and Improve Results Through Internal Audit. Before we begin, I'm going to play a brief housekeeping video.
Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. We'll email a copy of your PDF certificate in 2 weeks if you can't download it today. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, I'm going to pass the line to Amy to get us started.
Thank you so much, Emily. Hello, this is Amy Runge, and I'm going to be your moderator today. I am a partner in Moss Adams, and I serve as the long-term care practice leader. And I'm very happy to introduce you today to our two presenters, Findley Gillespie and Mary Wright. Findley is a partner at Moss Adams and has over 15 years of internal audit implementation and public accounting experience. He specializes in Sarbanes-Oxley consulting, internal audits, and controls-based consulting. Mary has been in public accounting since 1996 and is also a partner at Moss Adams. She works with collaborative teams to provide integrated audits, internal audit, and consulting services to governmental, healthcare, and not-for-profit entities. Today, our objectives are hopefully at the end of the presentation, you will be able to draw a correlation between current competitive and economic environments and the need to examine risk and control, be able to identify those risks and your key types of risk for your organization, understand the types of risk assessments that could be performed, including how to identify, rate, and assess risk, identify typical control failures, areas of risk, and the key factors to contributing to a strong control environment, and identify those resources that you have to cover internal audit processes. And hopefully you can take away any actionable items to jumpstart your internal controls. So with that, our agenda today, as you can see on the screen, is first of all, why examine risk and controls, understanding those risks, how internal controls can mitigate your risk, building a solution and where to start, staffing models for internal audit, and then finally, practical solutions for jump-starting internal controls. Findley, would you like to get us started?
Certainly. So thank you, Amy. So as we talk today, we want to go through a number of things, as Amy just shared. The first thing we need to do is have the conversation on why. So why are we looking at risks and controls? So to begin with, what we want to point out is that in this current kind of economic environment, there's a lot of pressure to do more with less. And as part of this is we want to look and we want to talk about controls, we want to look at risk, and we want to do that from the lens of how do you improve operations, how do you actually improve results through having strong internal controls. As part of this is we know that given the pressures that you're facing, whether it be consolidation in the industry, competition from new facilities, et cetera, you need to be able to do more with less. And so as part of that, we're going to look towards some of those ways that you can actually do that. When we think about improving performance, part of that is going to be looking at potentially some fraud, and I know that's why a number of you might have called in. You wanted to hear stories about fraud or how you can prevent fraud, but it really goes beyond that. It extends towards looking towards how to improve operations. It looks towards how do you improve reporting for management, how do you report out to others, et cetera. So as part of this is really kind of this current economic environment we're living in really demands a more agile, effective, and efficient corporate governance function. As part of that, we're going to talk about what that really means. So as we get into this, let's talk a little bit about risks that your facility might face. So a lot of times people think controls, internal audit, all those types of words, all those types of groups are really just contained to the accounting and finance folks. And we know that we have a number of people from accounting and finance departments here on the phone and leaders within those departments. But what we want to do is really highlight three key areas that controls and risks are really contained within. The first one is really operational. So you can see on your slides in front of you a couple examples as it relates to operational types of risks that your organization might be facing. So that first one could be care. So as part of that is, you could have a risk that your acuity assessments or your care assessments are out of date. You may, the level of care you're providing to your residents may not sync up with really that resident's true need. It could be a revenue concern from an operational standpoint. It could be that you did process through rate increases, that those rates aren't keeping up, and certainly also as we think about care, is the amount you're charging for care may not be keeping up with what the residents truly need. It could be that you have non-market rates in some of your buildings and some of your units. Maybe a resident moved in, and they moved in and they were living with their husband at the time. He's since passed away, and that hasn't been updated, right? Maybe they're living in a two-person room or a semi-private room, and it hasn't been changed, right? So again, some of those things are risks that you might face operationally. Safety, certainly, thinking about that, and there's been some very unfortunate press around this in the past. Certainly, if residents have access or don't have access within the facility. And so as part of that, also looking at pets, whether that be companion animals, whether it be a facility animal that's in the building, therapy reasons and otherwise, just understanding what some of those risks are. And we think about a lot of these really look at the operational nature of the organization. Now, some of these are going to have impact into kind of the accounting and finance department, certainly, and we're going to talk about that today. But again, think about those operational things. Operations really the front end of all of these sorts of things. And certainly there's going to be an accounting piece to it on the back end, but it's really about some of the things that we've been talking about in terms of efficiencies, in terms of a lot of these areas. And so when I think about this specifically, and as I said earlier, is you have to do more with less. We know there's a lot of challenges within staffing, certainly in just turnover and having some consistency among staffing, consistency between your different facilities, and kind of how do you have a centralized or decentralized model towards staffing all this. Again, these are some of the risks that you face from an operational perspective. Thinking about that next category of risk, we would describe that as compliance, right? So certainly licensure is critically important with the state coming out and doing surveys and the results of that, CMS, and I don't know what piece of your business might be Medicaid funded, but again, thinking about that. So there's certainly some compliance issues there. It also gets into things like employment, whether it be HR or employment law, timekeeping. Certainly if we have employers on today from California, some of those things are very, very complex, very, very challenging. When I think about health, safety, environmental, right? So not just pets, which you mentioned up above, but as well as, what it's food safety, whether it be maintenance, all of those things, contracts, compliance, maintenance of those. How do you know what you're having to comply with? Again, there's a lot of different moving parts, and it's not just solely kind of the compliance things that we naturally rush to or think about when we think about compliance in a senior facility environment. So again, this is the second area of kind of those key area of those risks. The third one is the one that you would expect to lead with, which would be that finance and reporting area. But again, not all those reporting areas are reporting of just key financial data. It could be things like census or reporting, right? I know that I've worked with a number of organizations in the past, and sometimes through an acquisition, when they're talking with other operators with respect to how occupancy is calculated, there's certainly some different views, and I mentioned that earlier. So if you have a resident and they're one resident in a two-person room, is it a private room? Is it a semi-private room? Is it companion living, non-companion living? I'm not sure what terms you guys use to describe that. But again, understanding occupancy, having some definitions around that, and how that gets reported out is critical to your business. In addition, then just management reporting. So this doesn't have to be reporting externally to shareholders, to banks, et cetera. But again, management reporting. How do you kind of look at things from a same store comparison standpoint? Again, as you look across the suite of potentially the facilities that you're running, how do you have consistency there? Are you truly comparing apples to apples? Flash reports, looking at move-ins, move-outs, what's going on within those facilities. Again, these are some of the risks that your organization faces. That next one of fraud, I know, like I mentioned earlier, we are going to speak towards fraud today. And certainly controls are key to both preventing and detecting fraud. And certainly there's a couple different types of fraud. The two I wanted to highlight just right now, one is misappropriation, i.e. theft of assets. And then the second one would be fraudulent financial reporting. So again, on that side, that could be reporting inaccurate data to banks, to shareholders, to others. So again, these are all risks that your organization faces. And then as well as billing and collections, this is one where I know just specifically, a lot of times we think, okay, well, it's kind of lives in operations, it kind of lives in accounting. Are you able to do this? And certainly there's a number of compliance areas around this. But, on kind of that billing areas, how are you billing? Is it accurate? Is it timely? Are you in compliance? I had a client where they were billing rooms out at a rate that actually wasn't allowed for because they didn't have sinks in the rooms. And so they required that to actually count towards a different type of unit where they could charge a much higher rate. So again, it's some of those things as we work through this. So with that said, what we want to do is dive in and talk a little deeper about a few things, right? But before we do, let's talk about getting to some real specifics on some of those exposures. So I gave kind of those three groupings. So what could that be? Fraud. That's the first one, and I know one that a lot of you called in to hear more about, right? So fraudulent financial reporting, right? Again, which is what I already shared. Misappropriation of assets. And then the third one could be expenditures or liabilities for improper purposes. I think a lot about some of the things that Mary and I've seen at different clients over the years, and a lot of that's in a decentralized environment where you may not have full visibility because you're not physically there. You may not have full visibility into how those dollars are being spent. So as part of that is that those expenditures could be made for goods or services that may never be received by the facility. They may be ending up somewhere else. Again, some of those fraud risks we're talking about. Inaccurate financial reporting, right? The inability to make sound financial or operational decisions. So much of that financial reporting is not really a thing that lives within accounting and it's reserved there, but instead accounting is there to support those sound financial operational decisions as you manage your business. And so as part of that, certainly is getting accurate information out, like I said, on the same store basis, looking at some of those trends. It could also be misrepresenting financial position or results to investors, banks, others. Certainly with so much acquisition and consolidation in the industry, making sure that you've got good, sound numbers as you do that. Lost efficiencies. This is one I want to pause on for a second. A lot of people have this conception that controls will actually slow things down within the business, and make things overly burdensome, or add this bureaucracy that they really don't want to have within the organization. But what I would say is that when controls are are designed properly, designed well, you actually get efficiencies. So as a specific example around this one, let's take the purchasing process. If you've got a purchase requisition or a PO software tool in place, you've got a tool to help with that, it can actually route things through much, much quicker than trying to figure out how you do this, or just letting everyone buy whatever they want, certainly, right? And so there's an opportunity where you can actually get some efficiencies if you have the purchase rec be transformed to a purchase order, and then, when you receive the good or service in, it just gets checked off, and it'll actually allow your accounting department, and I know we have a lot of accountants on the phone today, that'll be more efficient for you, and it'll also get those approvals up front before the monies are spent or committed to, instead of on the back end afterwards. So again, that's one of those things where it's misconception around controls, that it takes so much longer, that it doesn't provide for some of those efficiencies, and certainly with the concept that you need to be lean and move quickly, sometimes that's viewed as an impediment to having good controls. The next item we wanted to just highlight here, and we're going to talk a little bit today about, is just strategic objectives. As part of this, not only can controls and risk live in those three areas that we talked about, which is operations, compliance, and financial reporting, they could also live, they could also live within the strategic area. And so part of that, certainly, if part of your strategic plan is to grow through acquisition, to grow through building new facilities, although with cap rates being what they are, I don't know if that makes sense, certainly, but as part of that, if that's part of your strategy, again, having good sound controls can help with that. So as you go into diligence, as you start having those conversations around acquiring new facilities, that might be an opportunity for you to have kind of a set series of things you do, instead of just kind of kicking the tires, if you will. So again, controls can help in a lot of those areas. The last one we want to highlight is just compliance and reputational risk. Certainly with just the prevalence of social media and what's going on within news or the newspaper, there's certainly a need to protect that, certainly. And so there's been some very unfortunate news in articles that have come out in the past, whether it be a Dateline article, newspaper, et cetera. And it's part of what you're doing in helping your residents and the services you provide. You're dealing with a very frail group, potentially, of residents. As part of that is to having good controls can help ensure their safety and help keep you out of the newspaper for those things you don't want to be in there for. So again, those are some of those great things. It's kind of overall kind of our concept as we go through this, and what we wanted to share today is that strong internal controls can both prevent and detect your risks and your exposures. Mary, you want to cover the next section for us?
Absolutely. Thanks, Findley. To make sure that we are all on the same page with regards to the definition of risk and internal controls, both are summarized here. Risk is defined as the possibility that an event will occur which will impact an organization's achievement of objectives. One of the key takeaways here is that in both definitions here, achievement of objectives is a key term. Moving on to the next slide here, internal control objectives are broken down a little bit further. Now, Findley has already mentioned these already, but it's a nice visual to be able to recap the three different areas. The reporting section is in the orange is the area that people most commonly connect to internal control objectives, but there are other two very important objectives, again, as Findley had mentioned. Operations in the red, how can we most efficiently and effectively use our resources? And compliance, how do we keep our organization safe and in compliance with laws and regulations?
It looks like we're ready for our first polling question. Please remember to participate. You need to click the button next to the answer you choose and hit submit. I'll give you a few moments to respond. Okay, let's see what our results are. Okay, so most of you picked operations. I'm a little surprised. I thought compliance would be the top rated area. I get a lot of questions from my clients related to compliance with laws and regulations, but definitely operations makes a lot of sense as well.
Great. So what we'll have today is we're actually going to speak towards a lot of these operational areas, and certainly that was part of the title of our webinar and in the materials, but we're going to speak a lot towards operations. And certainly, again, as we go through this, feel free to ask questions at the bottom. We'll have some time at the end to respond to those. And if we're not able to respond to some of those or that require a little more dialogue, then we can certainly follow up with you. Mary?
Great. Now we have some basics out of the way and our terminology is defined. We're going to start thinking about how this really applies to your organization. What we have here is a visual that breaks down control environment maturity. Organizations can be anywhere on the spectrum. As we talk through each one of these areas, think about where your organization lands on the spectrum. That's important because obviously it helps to prioritize the next steps with regards to your internal control environment. The spectrum ranges from level 1, unreliable, which is basically no controls at all the way up to level 5. Briefly, the levels in between 1 and 5 include informal, or level 2. Here you have controls, however, they're not always documented. So if someone leaves your organization, you may have issues due to the lack of that documentation. Next is standardized, or level 3. Here the controls are designed, they're operating and documented. The major downside of this level is that while your organization design is documented and in fairly good shape, you're not always going to know if something fails. It's possible that a control activity may not be performed correctly or not performed at all, and you may not know. Level 4 is called monitored. This level adds steps to make sure that you will know that controls are operating as designed because you are testing those activities. And then finally, level 5 is called optimized. Here you have a fully integrated internal control framework with real-time monitoring. So you're going to know right away if something is going wrong. To give you perspective, in most cases, you really don't need to be at a level 5. If you get to a level 3 in your organization and perhaps start working towards attributes of level 4, you're in a really good position.
And that brings us to our next polling question.
Yes, as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Let's see what our response is. Okay, so most people fall between 2, 3, and 4. I'm glad to hear nobody is a level 1, but we have some room for improvement.
So as part of that, when I think about that key difference between level 2, level 3, and level 4, it goes from not having consistent controls in level 2 to having standardized controls in level 3, but not knowing. So if those things didn't occur, kind of that difference, key difference between 3 and 4 from our viewpoint is in 3, they're standardized, they're being done, but at 4, you know that they were done. And that's, as we talk a little bit about this today, some of those things can be very simple in terms of how you know they were done. It could be as simple as a checklist, if you will. So we'll talk a little bit more about that today. But again, I would encourage you to think about how you can move your organization up that maturity scale.
Great. Thanks, Findley. So keeping in mind, again, where you're at on that spectrum, we're going to talk about the benefits of proper controls. Good controls can help with fraud prevention. However, that's, of course, not the only area impacted. Big picture, good controls reduce risk given your current pressures, and good controls allow for growth and the improved operational performance of your organization. In addition to ensuring that objectives are met, as we noted previously, another key benefit is that risk can be detected on a timely basis or perhaps avoided altogether. So to wrap up this section, we have one more slide that we wanted to cover. We want to make sure everyone is aware of a few additional terms that will help lay the foundation for the rest of the presentation. First, it's good to understand preventative versus detective. Preventative controls are designed to catch errors or fraud before they occur, and detective controls are designed to uncover issues that have already occurred. Every control out there can be classified as either preventative or detective. Both types are important, but in general, preventative controls are preferred because oftentimes they're cheaper and you can possibly avoid negative impact altogether. All controls are also classified as automated or manual. Automated controls are typically more reliable than manual controls because they're not subject to the same degree of human error. However, there are places where manual controls are really important, especially in complex processes or where judgments are required. So moving from theory to real life, some examples of internal controls that fit into the 4 areas at the bottom of the slide include things like requiring review support of supporting documentation and approval for all disbursements over the certain dollar threshold at your organization. Perhaps using passwords to stop unauthorized access to systems or applications. Monitoring expenditures against budget, and also comparing receipts to credit card statements to ensure expenditures were appropriate.
Great. So now that we've got some of those key foundational elements in place, what we want to ask is, where do we start? So that's a great question. So as part of this, what we want to do is begin really by thinking about kind of what's in scope. What does kind of that risk universe look like for your organization? One of the things we always want to do is we start this effort, and we're going to talk a little bit about it, is understand which of those areas, again, operations, compliance, financial reporting, and potentially strategic, what are those areas that you really want to cover through this effort? So as you think about this, that scoping exercise, some of the things that we encourage you to do is start with a survey. You know, it doesn't have to be formal. It could be conversations that you're having with executives and other leaders within your business, really asking some of these questions. It may extend to maybe questions that you've received from the board or from others recently, from some of your peers, asking about questions on how does stuff work here at your organization. But ultimately, what you want to do is begin to think about kind of what's in scope, out of scope, where do you want to go with this effort. And this will allow ultimately for you to focus some of those internal audit efforts as you go through it. So what I encourage you to do first is, after you've defined really that scope, is then start brainstorming risks. And again, you don't need to really think about risk in terms of quantifying them or thinking about, oh, no, we've got great controls, we've got good processes, we've got good systems, good people. Don't do that yet. Instead, just brainstorm risks. And once you're done with brainstorming those risks, again, within those key areas you're focusing on, then what you'll do is begin to assess those. And what you see here on the slide in front of you is 2 things that we'd encourage you to use in terms of assessing those risks. The first one on the left-hand side is impact. So that could also be called magnitude, severity, these sorts of things. But again, the idea is, how significant is that risk to your organization, right? What is the impact, severity to your organization for some of those things? And as part of this is, if you look through these bullets on the left, here's some of the things that can help you evaluate what that is. It could be the effect on achieving your goals, your corporate goals. It could be the financial amounts at risk. It could be just reputational impact, right? And so a lot of these things are very, very challenging to compare because they're so dissimilar, right? Between dollars, goals achievement, and reputational risk, those are radically different concepts in terms of how you would rate those, because not all of them are going to tie to a specific dollar amount. But again, some of these are some of the things I would encourage you to think about as you evaluate the impact or severity of some of these risks. And again, what you want to do is you want to do this absent considering your controls. So again, start with that brainstorming, just identify the risks, and then start evaluating here. And as part of this evaluation is before controls. Again, we want you to focus on those most highest risk areas. After you've identified those controls and started rating impact, then it's time to evaluate the likelihood of those occurring. So certainly start thinking about, how likely is that to occur, right? And one of the things I know we've had clients in the past where they go, well, it's happened once before, but it's so remote where it's never going to happen again. And we ask, what have you done since the incident? What have you done since that occurred that would change really what that landscape looks like? And a lot of times, regretfully, the answer is nothing. And so as part of that is really being honest with yourself of, okay, have there been past issues? And as part of that, what's been done? And, are you still operating in that space? Do you still, as an example, potentially, do you have a memory care or an Alzheimer's wing? If you do, that risk still remains present no matter how great your controls are. So as part of that is understanding what that likelihood would be. So once you've done both of those, I would encourage you to put it on a heat map like this. This is a tool that we use very frequently. It works very, very well with boards and other executive groups, leaders like yourself, in terms of evaluating risk and thinking about that. And so what this is a heat map that's commonly used within the industry. And what it is comprised of those two factors I shared on the prior slide, but again, mapped out visually to be presented. And so let's take a quick look at this. Horizontally on the horizontal axis, you've really got that likelihood of the issue. Again, it was the right-hand column from the slide before. And then vertically up the page is, again, the severity and the importance of the business performance. Again, you can pick your terminology there, whether it be magnitude, severity, importance, etc. But again, it's that concept is the higher things are on this slide, the more severe they are. So let's just take one as an example. If you see in the upper left-hand corner, you see risk management in the yellow band. And what that means really from this sample client, what we're saying is that risk management, whether it be professional liability, general liability claims, some of those areas, what we're saying is that is a very significant risk to the organization. The impact of if that risk were actually to come true, right? If something were to break there, so to speak, it would have very significant impact on the organization. That's why it's rated so high on this chart. But in terms of where it overall stacks, what we do is you can see it kind of in the left third of the chart here. The reason for that is because while it's so severe, the likelihood of some of those things coming true or those events from occurring is actually lower, right? So again, it's kind of in that first quartile, kind of the beginning of the first quartile there. So that's why it ranks there in the yellow category. And so as you brainstorm these risks, you start plotting these out and something like this, one of the things I can guarantee is as you share this with other leaders in your company, there's going to be some discussion and potentially some heated discussion on where things line up. But what I'll tell you is it's a very, very good opportunity to get aligned on where your organization is, where your organization is going, and what are some of the risks that your group faces. We've seen this a lot, and Mary and I have shared this with a number of clients, this visual, and it's a great way to get that dialogue going. And what I can guarantee this, even if there's some, like I said, heated discussion, at the end of the day, you'll really learn some things about your organization. You'll learn some risks that weren't there in the past, or you may not have known about or couldn't quantify in the past, as well as you'll get a feeling for the risk appetite for those around the table with you. So again, this is a really good tool. Amy?
Yes, for our next polling question, for those of you that would like a copy of today's slide deck, you can download them from the folder that says Slide Deck and Handouts at the bottom of your screen. We will also be sending the slides via email after the webcast. Let's see what our responses are. It's interesting. Inexperienced teams and internal controls not implemented is your biggest threat.
Great. So as we think about this, I think really as we go through the rest of this deck, we'll look at kind of what your teams look like and how that fits in. So I'd encourage you to be thinking about some of those responses and really as it relates to some of those items, how can you do this given the team that you have? So before we go a little bit deeper into this, a lot of times it's asked, okay, what type of risk assessment are you actually doing? And so we've got 3 examples here of different types or different common types of risk assessments. That first one, and certainly this term is of no surprise to the group today, that first one is an enterprise risk or ERM tool, or ERM risk assessment, which is enterprise risk management. Again, this is a concept that's been out now for a while, but some of the challenges is how to adopt that. What does that really look like? Who does it report to? All of those things. But what I define as the key characteristic of an ERM risk assessment versus some of these other assessments we'll go on to is that it really focuses on the strategic risks as well and includes that in the suite of those 3 other areas that you would typically look at. So again, that's one of the hallmark features of ERM versus some of these other ones. The middle column there, which we've called internal controls assessment, and this could be done through an internal audit function, this could be done by you and your peers, right, is really evaluating controls. So again, this is evaluating maturity of processes and controls, really assessing those risks and looking towards how do you develop stronger controls, stronger processes. So that's the one that most commonly we're thinking about and what we'll describe for most of the rest of the presentation today. The right-hand column is actually fraud risk assessment. And I know that frequently when people think about controls, they think just about fraud prevention or fraud detection. Again, you can do a risk assessment based solely around this. In fact, your auditors are probably doing that right now. It's related to a lot of those fraud areas. But I encourage you to think about this as well and certainly not leave that out, no matter which type of risk assessment you're considering. So now that we've gotten this far in terms of defining kind of what a risk assessment looks like, you've got that tool of the heat map. The question is, okay, what should you do? How do you balance this idea of cost and benefit of controls? What should you focus on? So here's a couple thoughts for you. First is we would encourage you to leverage some of those automated controls, as Mary mentioned earlier, right? So you've got automated, you've got manual controls, and you've got automated controls. Again, looking at some of those automated controls can help provide some of that efficiency that I know a lot of times people say, well, controls are not efficient, they're less efficient. Well, if you leverage those automated controls, they in fact can be more efficient. Also, as part of this, when you think about focusing on this, is you want to marry up the amount of control assurance to risk, right? So what that means is you don't need to have 8 controls over something that's a very low risk area and 0 controls over something that's a very high risk area. Now, certainly that's an obvious statement, and I know you're thinking, Findley, that didn't help me too much. But what I'd say is if you took a real good look at your organization, I'm sure you'd be surprised where you see that mismatch of controls versus risk, or where you might see excessive controls around one area. Maybe it's just because you've grown so rapidly, some of those controls haven't kept up. Maybe it's because there was a particular incident or something that happened in the past, and so you've got some of these legacy controls. Maybe it's because you've now got new systems in place. Maybe you've got some purchasing card or P-card systems in place. Maybe you're using Concur, maybe you're using some of these other things. And ultimately, you've got like 8 layers of controls. Just as things continued to change, you added more and more control, and it may be in an area where you don't need as many. One example I'll share with you from a client here recently is where there were times where the same person would have to approve a purchase between a contract, a purchase rec, a purchase order, the invoice, and even signing the check or approving the wire, where they would have to have some pretty senior people within their organization sign things 4 or 5 or 6 times over the exact same transaction. And again, that's an example where the controls, as they kept adding some complexity, as they grew, they kept layering on controls, and pretty soon you had the exact same person approving something 5 or 6 times. It was the exact same piece of paper. So again, the idea there is to be efficient in what you're doing and marry that up. Certainly looking at compensating controls. Compensating controls are where you have another control that also covers that. So certainly you want to have more than one layer of controls, but really I would encourage you to begin with good, sound primary controls and then have some of those mitigating or compensating controls there as well. All right, so what can you do to improve, right? So we're talking a lot about cost and the cost benefit of controls. What we'd encourage you to do is look at some of those IT controls first, those application controls, right? And before you actually implement new controls, and this goes back to my comment or my example where we had somebody looking at the same piece of paper 5 or 6 times, right? Before implementing a new control, ask yourself what could go wrong. Is there another control that limits what that exposure is? Ask yourself what could go wrong. I love that question because if the answer is ultimately what could go wrong, not much, then you don't need any new controls. And again, we want to be clear on when to add controls, when to revise your existing controls, etc. So again, as part of this is the likelihood and the magnitude of the risk or the exposure should really be tied back to that control and done in a way where that cost of performing the control, the cost of having all that done, it makes sense in terms of the benefit that you'll receive. So again, let's focus on that. So now that we have that in mind, the question is really where do you go with all this, right? So let me take you through this visual that really describes what this looks like. So that first column of risk scope and risk planning, that really is identifying what you'd want to include in this effort and what you wouldn't want to include. So as an example, if you already have a very active compliance group, you may want to leave that out of this work that you're doing right now. On the other hand, you may also want to include that. You may also want to include strategic risks, et cetera. But again, start with that kind of that risk scoping, if you will. Then you go into that risk identification. Again, we've talked about this before, but it's that brainstorming of risks, right? So that could cover financial reporting, can cover kind of entity level controls, or just kind of the tone. How are things done around here? It could speak towards fraud. It could talk about IT. It could talk about compliance. But again, just identifying risks, right? And again, looking at that before controls, and again, just getting the risks down. From there, then assessing risk, rating them through likelihood and magnitude. Again, like we talked about, plotting those out. And then from that is then saying, okay, what are we going to do with these risks? And certainly you don't have to do everything with all of these risks, but here's some options for you. The first one could be to avoid the risk, right? So if you have a risk and you consider one of your facilities, and let's say that you've got a facility in Chico, California, maybe then the answer is, okay, at that, what we're not going to do is we know that facility, just the way the facility is physically designed, doesn't allow us to have good controls operationally around managing an Alzheimer's wing or a memory care unit. I'm not sure what you call it within your organization, but as part of that, you may say, boy, we need to avoid that risk. And so maybe from that facility is more independent care. Maybe that facility is assisted living, but it doesn't include some of those aspects that you might otherwise have throughout the suite of your properties. So again, that's a way you could avoid the risk. The second one would be just to accept the risk. And not everything you're going to put down on this chart or on that heat map is going to be something you have to do. So again, realize that and don't make yourself go nuts trying to kind of anticipate what you are and aren't going to do when you're brainstorming. But again, you may just say, yeah, we've accepted the risk. We know what it is, and we're going to move on. The third one would be share that risk, so that some of these risks are actually insurable. Right? So again, consider that. And then the last one would be to reduce the risk. And the way to reduce the risk is to build in strong internal controls. Right? And so that's what we're going to spend the balance of today's conversation about, is how to do that. So as we do that, let's talk a little bit about what internal audit looks like and what some of those staffing models could be. So as we think about internal audit, here's a definition of what internal audit is. This is brought to you by the Institute of Internal Auditors, or IIA, which is the lead organization in this space. I'm going to highlight on just a couple things that they say. Internal auditing is an independent, objective assurance and consulting activity designed to add value and improve an organization's operations. So as part of this, the keywords are really highlighted here, but independent, objective, assurance, and consulting. Right? And when I think about this, as you think about the staffing models that you have to do some of this work, it's important, certainly, that you have independent, objective people performing this work. Certainly, it's going to be both an assurance activity and a consulting activity. And I think that's a key piece. A lot of times, internal auditors are viewed as enforcement only, but not on the consulting side. And that's really too bad for the industry, and it's really too bad for companies as well. So again, it needs to be both an assurance and consulting activity, and ultimately with the idea of designed to add value and improve operations. Without that, then it really struggles to have a good spot within the organization. And I encourage you, if you have an operation and it doesn't have some of those key pieces, really, it doesn't make a lot of sense, and you should retool that. And again, that's why sometimes internal audit gets a bad rep. So now let's turn to our next polling question.
And this is our final polling question. Once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the certification icon at the bottom of your screen. So let's see what our results are for our final question. So the majority of you have no internal audit function at all, and then there are some that have more than 5.
Yeah, so that's really interesting. I know that a number of our clients, and it depends on how you count how you count heads for internal audit. A number of them will have people within compliance and other groups that do largely internal audit function. I think that's probably some of why you see that more than 5. And then we know a number don't have an internal audit function. Maybe you've got some people kind of working on documenting some policies or procedures right now, but you may not have a true internal audit function. So as part of this, kind of the dilemma here as we think about this is, on the top half of the screen, there's increasing risks, right? Given kind of the current economic landscape, given the news environment, given just everything, the pressures that you face, market competition, we mentioned cap rates earlier, fraud, all of those things. The risks continue to increase. The challenge is that you don't have unlimited dollars to spend, right? And so your resources, your ability to respond to some of those is actually decreasing. You're being pressured, right? So, whether it be reduced profitability is a pressure on that, whether it's requiring specialty audit skills or specialty skills. I think about cybersecurity as an example, and I think a lot of organizations are struggling with that, trying to figure out who they can have help them with that, and it's a very expensive skill set. But again, I think that's a challenge where we've got increasing risks and decreasing resources. So one of the things we want to talk about today, and just practically talk about, is how do you staff a potential internal audit department? And you really have two different models. The first one we see on the left side is kind of the in-source model, and this is the typical thing we think of when we think about an internal audit, where you hire an internal audit or a group of internal auditors. Certainly saw some of you have 5+ people employed, some of you have none. But as part of that, it's where you've got internal auditors on staff, right? What's great about that is that they're there, that they're present each and every day, and that's fantastic. They're also a fixed labor cost, which is can be great in some respects because you know what that is for budgeting, et cetera. At the same time, you can't tell them to go away when you don't want them, or if it's a busy time of year, busy time within your group, so that you've got that fixed labor cost. The other thing we've seen at a lot of organizations your size is if you have turnover in that one individual, then that expertise leaves the building, so to speak. And so what you do is you may have the effective turnover is pretty significant when you have a small group. Also, they may not have some of the specialty skill sets that you would need. So again, that's that in-source model, or kind of that model where you'd hire an employee. The second model would be an outsourced model. And that could be a variable cost. So if there needs to be more audits done, or more work, or kind of consulting or advisory help done over a specific area, that could scale up or scale down. As part of that, they can be available when needed. It's a variable cost. As part of that, as we think about that, it really should pay for itself. And if it's not, that's a challenge. I know in the work that Mary and I do for other organizations, we always want to do that. We want to make sure that it pays for itself. And as part of that is bringing a real structure. Kind of that co-source model is really the third of those options. And part of that is what it would look like is essentially a hybrid model where you have an outsourced provider helping with internal audit, but then you may also start adding some employees internally. And as part of that, that's a pretty cost-efficient model as you continue to grow and expand. So when we think about kind of staffing models, when does it make sense? And obviously some of this is challenging, just given the size potentially of your organization, or the complexity, or if you've got other resources doing this work, right? But as we think about it, if you think about revenue horizontally across the slide, and then internal audit costs vertically, here's kind of the kind of break-even point. Is somewhere potentially at kind of $1 or $2 billion mark. Again, depends on how you're defining all such things, including how many compliance people you have and their role in this. But as part of that, what you can see in the green line is that essentially if you hire internal audit, you have an instant pop in terms of costs. But if you go with that outsource model, it grows at a slower rate. And then ultimately, the internal audit cost is certainly going to be lower over the long term. It kind of depends on where that is. So again, that's an opportunity as you kind of think about what this looks like. A lot of organizations would start when they first develop an internal audit department. They would start actually with outsourcing that and then transition over. And a good way to do that is kind of that co-source model that we talked about. Great. So as part of this kind of outsourcing for the middle market, and when I think about that, one of the keys there is really to find a provider that can help and be flexible in what that looks like. They have the resources to take on the different audits that you need. So again, thinking about that risk assessment, that's going to help drive and set up that audit plan. This outsourced provider can also help do a risk assessment, and then would tell you really what you need to do in terms of hiring people or retaining a firm to help with that. We're doing a risk assessment right now, with the end point being so they're going to hire people when we're done with the risk assessment, but they want the risk assessment so they know who to hire. So again, a great opportunity for that. Mary?
Thanks, Findley. The last section today is focused squarely on the practical solutions when it comes to internal controls. Specifically, we want to start with fraud prevention and detection. First of all, it's helpful to have a solid understanding of the types of fraud that can impact your organization. I know that examples really help me as well. Financial reporting fraud. You are in a highly leveraged industry, so there's an increased risk of fraud related to compliance with debt covenants. You need to be on the watch for manipulation of known covenants. In addition to known covenants, are there other covenants out there like repairs and maintenance or capital expenditure commitments that must be adhered to? Misappropriation of assets. Do you handle cash for your residents? Could a business office manager be taking cash from residents and then writing off the charges? For expenditures and liabilities for an improper purpose, could an employee be putting a personal expense on a purchasing card, for example? How would that be caught? On the revenue side, could the organization be charging multiple parties for a fee for one resident, perhaps charging the resident, the adult children, and the state? Costs and expenses avoided by fraud. Could a general manager inappropriately move costs or shift them around to another facility or to corporate, for example, payroll or facility costs? And then finally, senior management misconduct. Findley mentioned this one before. Could management be forcing delays on processing move-outs, forcing early move-ins, or adjusting census and occupancy numbers? What checks are in place to make sure that's being monitored? Now that we have you thinking about some examples of fraud in your industry, let's talk about how we can avoid fraud. Segregation of duties is one of the most critical components for preventing fraud. If there's truly segregation of duties in a given process, two people would have to collude in order to commit fraud. Controls over system access are also key to fraud prevention and detection. You need to allow enough access to be able to do your job and continue with operations. However, we commonly see more access than is necessary in a lot of organizations. The key question here is, what can a user do in the system, not what are they supposed to do? Bank accounts, do you have spending limits, and is there access to funds appropriately segregated so that one individual doesn't have too much control? And finally, do you have positive pay on all checking accounts to help prevent fraudulent checks from being paid? Drilling down a little bit more on segregation of duties, not only is segregation of duties a critical part of internal controls, it is absolutely necessary regardless of the size of your organization. Segregation of duties is, of course, the concept of having more than one person required to complete a task. For example, payroll, the individuals that process payroll shouldn't have access to change pay rates. Perhaps that duty should reside in HR. Obviously, the size and structure of your organization does impact how challenging it could be to implement strategies or segregation of duties, but there's always ways to help improve the situation regardless of the situation. So while segregation of duties is necessary for all organizations, you really need to take a look at your risk areas because they're going to be different, and you need to prioritize, like Findley had talked about, perhaps using that heat map tool. Once you have segregation of duties in place, the next step is to consider documentation of policies and procedures. I'm guessing that many of your organizations have documented policies. However, do they cover the entire organization, or are they just for certain segments, like for care areas? One key risk area here is turnover in your business office. Would policy, procedure, and process information be lost if you lost those key employees? There's a lot of different ways to document, so the important piece here is to take away is the documentation needs to be clear and concise. It needs to be communicated to all stakeholders so they know what the expectation is, and more importantly, you need to make sure that's being updated and reviewed on a regular basis so it remains relevant. We talked a lot about how policies and procedures should be documented. What we have here is common examples of what should be designed and documented. For example, on the compliance side, who's responsible for legal review? Another example, do you require business associate agreements? On the ops side, perhaps you have a budget, but is there any requirement to obtain authorization before a purchase of any significant size is made? The final few slides here touches on IT controls. The key here is technology can absolutely help us. Efficiencies like Findley had mentioned before, But there's also related risks that need to be considered. Data reliability is one common area of uncertainty. To evaluate your organization's potential risks in this area, a great place to start is to consider whether there's a lot of manual adjustments necessary to make things work. The data reliability may be a challenge if that's the case. And then again, who has access to your system? Are those the right people to have access? When you set up the system and it was implemented, was it set up correctly? How do you know? Has that been tested? Drilling down a bit further on IT environment, what we have outlined here are some common examples of the related controls for application controls. Step one, make sure you understand what's in place. The second piece is to understand if you're fully using those, utilizing those application controls. And then finally, are the control activities being monitored and is action being taken as necessary? For example, is there a process to understand why something may be going wrong and causing an exception? Can something be fixed on the front end of the process to avoid this exception? Final slide here recaps application control benefits. Time and cost savings is one of the key benefits, obviously. Also, because the related controls operate through and within the IT systems, they function systematically and work with a high degree of consistency, so the likelihood of manual errors is reduced. Findley.
Great, so we're just about at the end of our hour here. What I wanted to do now is just close with some suggestions for success. Again, we'd encourage you to start with that risk assessment. And again, this can be something as small or as large as you want to make it. So if you're asking yourself, hey, I just have a set amount of time, or I'm only over this department, or I'm only over this this group within the organization, again, you can focus on that area. You could also expand it beyond that. So again, you can start as big or as small as you want. But I encourage you to begin having that dialogue around risk identification, that brainstorming piece, risk appetite, how you would evaluate those things, and how you want to respond. Then from there, that'll help you to begin to identify those areas that you want to evaluate your controls in. And again, it could be as simple as a checklist, or it could be complex. It could be documenting policies and procedures. It could require some changes in systems. Maybe you're already considering a system upgrade. And as part of that, you should be looking at some of those controls. But again, I would encourage you to begin thinking about those controls and also have that brainstorming, not on the risk side only, but then also after doing that risk assessment session, but also begin brainstorming the controls. I'm sure you'll be surprised by what some of your team members suggest or have ideas and recommendations on. And then lastly, I'd encourage you to consider the need for internal audit. Again, this is something that we've seen in a lot of our organizations. Probably the reason why you called in today is to say, when do we actually need that, and what would that potentially look like? How could that get started? But again, it's a great idea to start with. So just kind of a couple closing takeaways and some quick facts. Internal controls are key to preventing and detecting fraud. Yes, that's important, but it goes beyond that. It's not just about controls. Certainly, if your organization isn't examining your controls regularly, you should start. They are essential for all organizations, regardless of size. Again, this can't be, oh, well, we're too small for controls. Controls need to reside in all organization sizes. Certainly, you need to pair those controls with the risks. Segregation of duties is a critical element within internal controls. Controls do allow for scalable and well-controlled growth. Again, some of these controls you need to slow down to go faster, and I think that we see that in a lot of controls for a lot of the organizations we work with. And good controls really do increase operational effectiveness of your organization. So, they can detect errors, they can reduce rework, they can help with efficiencies, but ultimately they should be designed to help improve operations. And the very last thing I want to close with is actually the most important here, is that senior management commitment to internal control, and just your presence here today is certainly indicative of that. Senior management commitment to internal control is the most significant factor to having a strong control environment, to having good controls, and setting an acceptable tone throughout your organizations. So we thank you for joining today. And with that said, I'll turn you over to Emily to speak towards a couple last things. But again, thank you for joining us. And if you have any questions, certainly put those, feel free to submit those through the Q&A tab at the bottom, or to send those to us directly. Emily?
Awesome. Thank you, Findley. And thank you, Findley, Amy, and Mary, for a great presentation. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, You must complete the group attendance sheet found in the slide deck and handouts icon to the left of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 2 weeks should you have any difficulty downloading it now. And I wanted to remind everyone that we have our annual healthcare conference coming up in November. You can read more about that here and also by visiting the link to the left of your slide view. And you do have until June 30th to register with the early bird rate. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.